Is online Forex trading really legit? Online Forex trading is a legitimate and widely recognized form of investment, but it's important to understand both its potential and its risks before diving in. At its most basic level, Forex trading is about the buying and selling of currencies in pairs, such as exchanging US dollars for euros or British pounds for Japanese yen. The aim is to profit from the fluctuations in the value of these currencies relative to each other. For instance, if I buy USD at 1.10 and the exchange rate later rises to 1.20, I would earn a profit from the difference in the exchange rates when I sell. However, as simple as this might sound, there's much more to Forex trading than just guessing which way the market will move. One of the main reasons people question whether online Forex trading is legitimate comes down to the issue of regulation. Yes, Forex trading is legitimate, but its legitimacy depends heavily on the broker you choose. Forex is a decentralized market, which means that there's no single global regulatory body overseeing all transactions. Instead, regulation is handled on a country-by-country basis, with different regulatory agencies governing brokers in various regions. For instance, in the UK, the Financial Conduct Authority, FCA, regulates Forex brokers, while in the US, brokers must adhere to the strict guidelines set by the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA. If I trade with a broker in the US, for example, I know they must follow very stringent guidelines, including maintaining capital reserves and separating client funds from their operating funds. This adds a layer of security for me as a trader, knowing that my funds are protected and that the broker operates under the watchful eye of a reputable financial authority. A real-world example of this can be seen in the collapse of MF Global, a major US broker that went bankrupt in 2011. The firm was found to have misused customer funds, causing losses for thousands of traders. Regulatory bodies like the CFTC stepped in to ensure that clients could recover part of their money, underscoring the importance of dealing with regulated brokers that follow strict financial rules. However, it's important to note that not all Forex brokers are regulated. Some operate in countries with little or no regulatory oversight, which can make them risky to trade with. In some cases, unregulated brokers have been known to engage in unethical practices, such as manipulating prices or refusing to let traders withdraw their funds. For example, I've seen cases where traders sign up with offshore brokers who offer incredibly high leverage and zero commission fees, only to find out later that they can't withdraw their earnings. That's why it's crucial to verify that the broker you choose is regulated by a recognized authority in your country or a reputable international body. In addition to regulatory concerns, many people also question the legitimacy of Forex trading because of the risks involved. Forex trading is inherently risky, and it's not for everyone. One of the biggest risks is market volatility. The value of currencies can fluctuate wildly based on a variety of factors, including economic data releases, political events, and market sentiment. For instance, when the Brexit referendum took place in 2016, the value of the British pound plummeted in a matter of hours. Traders who had positions on the GBP-USD pair during this time either made huge profits or suffered devastating losses, depending on which way they had bet. Similarly, during the COVID-19 pandemic, currencies like the Australian dollar and South African rand experienced significant fluctuations due to economic uncertainty and global lockdowns. This kind of volatility can make Forex trading exciting, but it also makes it risky, especially for those who are inexperienced. Another risk to be aware of is the use of leverage. Leverage allows traders to control large positions with a relatively small amount of capital. For example, if I have $1,000 in my trading account and use leverage of 1 to 100, I can control $100,000 in currency. This means that even small price movements can result in significant profits or losses. While leverage can magnify gains, it can also magnify losses. For instance, if the market moves against my position, my losses could exceed my initial investment. This is why many experienced traders use risk management strategies such as setting stop-loss orders to limit their potential losses. Take the example of the Swiss franc (CHF) crisis in 2015. when the Swiss National Bank unexpectedly removed its currency cap on the euro. The Swiss franc soared in value almost instantly, and traders who were short on CHF, betting it would weaken, faced catastrophic losses. Some traders saw their entire accounts wiped out, and several brokers went bankrupt because they couldn't cover the clients' losses. This event demonstrated the extreme risks that come with highly leveraged positions in volatile markets. Beyond the risks of volatility and leverage, another concern is the prevalence of scams in the Forex market. Unfortunately, the popularity of online Forex trading has attracted its fair share of scammers. These scams often target inexperienced traders, luring them in with promises of guaranteed profits, insider tips, or get-rich-quick schemes. I've seen brokers advertise 100% win rates, or no-risk trading, to attract new clients. These are clear warning signs of a scam. Legitimate brokers never make promises of guaranteed profits because, in reality, no one can predict the market with 100% accuracy. That's why it's essential to do thorough research and choose a broker that is both reputable and regulated. Always check user reviews, verify the broker's regulatory status, and avoid any platform that makes unrealistic promises. One classic scam to watch out for is the signal seller scam, where a company offers to sell you Forex signals, recommendations on when to buy or sell based on supposed insider knowledge or advanced algorithms. These services often charge hefty subscription fees, promising traders easy profits. However, in many cases, these signals are worthless, and the service disappears after collecting enough fees from unsuspecting traders. It's always best to learn how to analyze the market yourself rather than relying on third-party signals that may not be reliable. While the risks are significant, Forex trading also offers considerable opportunities for those who are willing to put in the time to learn and develop their skills. Successful Forex traders are not just lucky, they invest considerable time and effort into understanding the market, analyzing price charts, and staying updated on global economic trends. They develop well-thought-out trading strategies, combining both technical analysis, the study of price charts and patterns, and fundamental analysis, analyzing economic indicators such as interest rates, employment data, and geopolitical events. For example, I've seen traders who specialize in trading around major news events, such as central bank interest rate decisions, which can cause sharp movements in currency prices. Others focus on long-term trends, holding positions for weeks or even months based on broader economic factors. If you're thinking about getting into Forex trading, it's important to start small and manage your risks carefully. Many platforms offer demo accounts that allow you to practice trading with virtual money before you commit any real funds. This is a great way to get a feel for the market and test out different strategies without risking your capital. Additionally, it's essential to only trade with money you can afford to lose. The high-risk nature of Forex means that even experienced traders can suffer losses, and it's important to be prepared for that. For example, I've seen traders who start with a demo account and gain confidence from a few successful trades. They then transition to a live account with real money, only to realize that trading with real capital comes with emotional challenges they hadn't experienced in the demo account. Fear and greed can cloud decision-making, leading to impulsive trades or holding onto losing positions for too long. This emotional factor is one of the reasons why even seasoned traders continue to emphasize the importance of discipline and risk management. In conclusion, online Forex trading is a legitimate way to invest in global currencies, but it's not without its challenges. For those who take the time to educate themselves, develop a solid trading strategy, and manage their risks effectively, it can be a profitable venture. However, it's crucial to approach Forex trading with caution, be aware of the risks, and avoid falling victim to scams. As with any form of investment, success in Forex trading comes from a combination of knowledge, discipline, and careful risk management. Thank you for watching.